Let me ask you a simple question. If you're about to buy a house today and someone suddenly told you that there's a new tax law and it could change how much you pay, would you feel confident to go ahead with your transaction, or will you be confused or even frustrated? Would you actually know how much tax you are supposed to pay and why? Because right now across Ghana, there are more conversations about the new VAT law and real estate, all in the same sentence, and more people are assuming the worst. And if you've been scrolling through social media, listening to radio conversations, and maybe just chatting with your friends and colleagues, I'm sure you probably have noticed something. Concerning this VAT law, there is some confusion and there are speculations and a fair amount of fear, especially when real estate is part of the conversation. On January 1st this year, Ghana quietly entered a new tax era with the introduction of the VAT Act 1151. This law changes how value-added tax works across the economy, and real estate is right in the middle of it. Now, some people are thinking that all houses are now taxed. Others believe that developers are just going to increase prices. And some are convinced that rent is about to go up everywhere. But here's the truth. Most of what you're hearing is noise, not facts. And when it comes to property, noise is very expensive. Now, in this episode today, we are separating rumors from reality and we're explaining Ghana's new VAT law, Act 1151, exactly as it applies to real estate. Not with fear, not with politics, not with technical jargon, but then with clear examples, real scenarios, and plain language. So if you're buying property, maybe you're selling property, you're developing property, you're renting, or simply working anywhere within real estate space here in Ghana, this conversation directly affects you. So don't skip ahead and don't assume that you already know this, because by the end of this episode, you'll understand when tax applies, when it doesn't, and how to protect yourself in Ghana's real estate markets going forward. So let's get into it. Let's start at the very beginning. What exactly is Act 1151? Now, this act is Ghana's new value added tax law, and it was passed by Parliament in 2025, and it completely replaces the previous VAT law, which was Act 870 of 2013. Think of this as a full system reset. Now, this law is not about real estate only, it applies to other aspects of the economy, from goods to services, imports, exports, and business transactions generally. But then real estate feels the impact more directly because property development and property related services are classified as business activities under this law. Now, one of the main goals behind Act 1151 is simplification. Under the old VAT system, taxes were layered in a way that was genuinely difficult to understand. You had the VAT itself, and then you had the National Health Insurance Levy, that's the NHIL, then Get Fund, and then on top of that, you had the COVID-19 levy. These charges were calculated quite differently, and in some cases, one tax was applied on top of another. And that is what tax professionals call the cascading effect. And the result was quite simple. People didn't really know what they were paying or why. So Act 1151 was designed to fix all this. Now, it streamlines the structure and also makes the system more transparent. And transparency matters especially when property and large sums of money are involved. Let's break down how VAT works under the new law in the simplest possible terms. Under Act 1151, the standard VAT rate is 15%, the National Health Insurance Levy, that is NHIL, is 2.5%, and the Get Fund levy is also 2.5%. Now, when you add these together, the total indirect tax comes to 20%. This is very important because under the old system, the effective tax rate was 21.9%. So, in very practical terms, the overall VAT burden has actually come down slightly. And here's another key change. The COVID-19 levy has also been abolished. That 1% pandemic era charge is now gone. There's also a very important structural improvement. Now, VAT, NHIL, and Get Fund are now calculated on the same base. And businesses can now claim NHIL and GET Fund as input tax credits. In plain language, this means that if a business pays these taxes when buying goods or services, it can deduct them from the tax it charges when it sells. Now, this is a big deal for developers and service providers because it reduces the effective cost of doing business when accounting is done properly. Just a quick reminder, if you find this podcast useful, please do well to subscribe to the channel because it supports us and helps us to do what we're doing. It allows us to keep bringing you real practical conversations like this. All right, let's continue. Now, let's address the biggest talking point. Under the previous VAT regime, real estate had a special arrangement. Estate developers and suppliers of immovable property for rental purposes operated under a flat rate VAT system, typically 5%. Now, that flat rate system has now been abolished. There's no longer a special flat VAT rate for real estate, and that's it. But then this is where clarity is very critical. This does not mean that every property transaction in Ghana is now taxed at 20%. No, it does not also mean that all houses will attract VAT. And it does not mean that rent has suddenly become taxable. What this really means is this. Where VAT applies to a real estate transaction, it now follows the standard VAT rules, just like the other sectors of the economy. One system, one structure, applied consistently. So when does VAT actually apply in real estate? Now, this is the most important section of this entire episode. Whether VAT applies depends on three things: who is making a supply, what exactly is being supplied, and whether it's being done as part of a business. Now, let's make this real. Let's take an example. Imagine an individual, let's call him Kwame. Now, Kwame built a house for himself and he lived in it for several years. Life changes and he decides to sell that house. Now, Kwame is not a developer and he's not running a real estate business either. He's just selling a personal asset. And in this scenario, VAT does not apply to this transaction. Now, let's take another example. And in this case, we're looking at a developer who builds multiple housing units specifically for sale and is registered for VAT. This developer is making what the law calls a taxable supply because the sale is part of a business activity. And in this case, VAT applies. Here's a key takeaway. It's not about the building, but then it's about the activity behind the sale. Meaning that once that activity is a business-related activity, it is subject to be taxed. Beyond the sale of a property, others may be asking, what about those who are renting? This is actually a big concern for many people because when you look at it, the supply of a dwelling place for residential purposes, meaning you renting a home or an apartment, is actually VAT exempt. That was true before Act 1151 and it remains true now. So if you're renting a home to live in, VAT typically does not apply to your rent. However, service charges, commercial use, or mixed use properties can introduce VAT considerations. And that is why reading your lease carefully is not optional. It matters because you need to know exactly what you're signing up for. What about commercial properties? Well, for this category, things are a little different. This category is treated quite differently. Office spaces, shops, warehouses, and serviced offices are generally subject to VAT when the landlord is VAT registered. Now, if you're a commercial tenant, always ask one very simple question upfront. Is the rent VAT inclusive or VAT exclusive? That single question can save you from unexpected costs later. So as always, before you sign up to anything, make sure you understand what you're signing up for. So what should developers expect? Well, developers are among the most directly affected by this change. And under Act 1151, developers making taxable supplies must charge VAT using the standard structure. But then here's the upside. Developers can now claim input VAT, including NHIL and GET Fund, on construction materials, professional services, and project costs. When this is managed properly, this can significantly reduce the effective tax burden over the life of a project. Now, this is the real shift. Accounting, invoicing, and cash flow planning now matter more than ever. Get it right, and the system can actually work in your favor. Get it wrong, and the opposite is true. If you're buying property, this part is very critical. Now, you need to always ask, is the price of the property VAT inclusive or VAT exclusive? And you need to also know if the seller is VAT registered. Now, One thing that is key is this property a new development or a private resale? You have a case where two properties can look identical on paper and still carry very different tax implications, and the knowledge here protects you at closing. What this simply means is that if I have a property, private person, and then I'm selling that property, there's no VAT implications. But then if I'm a developer and then I'm selling properties that I've built, well, VAT applies on that. So knowing the difference between the two types of properties will save you when you're transacting on a particular property. Now, for real estate agents and service providers, this is the quiet but then major change. Under this new act, service providers have no VAT registration threshold. Now, that includes real estate agents, property managers, consultants, and similar professionals. So, if you provide taxable services, you may be required to register for VAT regardless of the size of your revenue. Now, this is different from businesses that supply goods where the threshold has been raised to 750,000 Ghana cedis. So, if you're a real estate professional, you need to review your status now because the law is clear and penalties for non-compliance have gone up. In the short term, there will be some adjustments and there'll be questions, and of course, there'll be some learning curves. In the medium term, transactions become clearer and more transparent. And in the long term, of course, this will help build a more structured, credible, and investable real estate market in Ghana. The law is not anti-real estate, it's pro-structure. And structure, when done right, benefits everyone. Taxes can feel overwhelming, especially when property and large sums of money are involved. But then clarity removes fear. And if there's one thing I want you to walk away with from this episode, it is this: the law did not change to punish you, it changed to bring structure. Act 1151 did not suddenly turn housing into a luxury product, and it did not make property ownership impossible in Ghana. What it did was remove confusion, collapse multiple levies into one clear system, and draw firmer lines between personal activity and business activity. Act 1151 didn't invent VAT on housing. It just reorganized the system around it. And that distinction between what's personal versus business, that is where everything now hinges. And for some people, this means asking better questions before signing contracts. For others, it means registering properly and cleaning up your records. Now, for developers, it means tighter accounting and smarter pricing. And for the industry as a whole, it means moving closer to a more transparent, investable, and mature real estate market. This is not a moment for fear, but then rather a moment for understanding. Because in real estate, information is not just power, it is your protection. If this episode helped you make sense of what you've been hearing out there, well, do someone else a favor by sharing it. And you would see that you would end up helping a buyer, a renter, a developer, or an agent who needs this clarity before they make a costly mistake. Beyond all I've covered today, if you still have questions, that's a good thing. You may want to drop them in the comments. And of course, we will do well to keep unpacking this topic as the industry adapts. Because our job here is very simple: to replace noise with knowledge and to replace fear with facts. And of course, to help you navigate Ghana's real estate market with confidence, because your protection is in your understanding of the system you're operating in or the system you're getting into. So ask questions to get clarity, read contracts to know what you're signing on to, and as the stakes are always high in real estate, you may want to do well to seek professional advice where it comes in necessary. And that is how we all move forward, not with fear, but then with confidence. Many thanks for staying with me. Stay informed, stay grounded, and make decisions from a place of clarity and not confusion. I'm Desmond Kafui, and this is Ghana Ground Up. I'll catch you in the next episode.